Many of you have been asking me about my opinion on Nebius stock. The stock is down 32% over the last months. It's been really, really bad. And I actually did a video on Nebius 2 months ago. A lot has happened since then, so I want to do an update. But it was mainly a bearish take on Nebius where I highlighted some of the risks with the business model. And normally it's very hard to be bearish on anything on YouTube. But I try my best to give my honest opinion if there's something I don't like or something I don't see. I try to put it in a video, and I really hope you enjoy it as always. Now, the last quarter for Nebius was actually amazing. I mean, I have to be honest, guys. They sold out of their capacity. It's all sold out. They achieved about 19% on adjusted EBITDA margin for the core AI business. They got 355% year-on-year in revenue growth and 39% quarter-on-quarter. I don't know any company in the entire stock market that's growing revenues 40% quarter-on-quarter. So the revenue growth is absolutely insane. They secured some funding, about 4.3 billion through convertibles for them to meet their deals with Microsoft and Meta. And they did sign 2 deals with Microsoft and Meta. And I was really surprised, to be honest. I was not expecting that. It happened right after my video. The stock went up a lot. Now it came back to the same price. But I was really surprised that Meta and Microsoft did partner up with Nebius. Microsoft signed a monster deal of about $17.4 billion over a 5-year term. Meta signed a smaller deal, about $3 billion, but also over a 5-year term. And again, that's really amazing for Nebius, and it's going to bring them a lot of revenues, a lot of, you can say, backlog, something that they can see. They're not just throwing money in the water. They're raising some capital, yes, but they're using it to build the infrastructure to meet the demand of Microsoft and Meta, which they have them through a contract. I'm not sure how easy it is to cancel the contract, but at least they're not doing it hoping they can make more revenues. They actually have the revenues, and they're just putting up the capital to meet the revenue project that they got from Meta and Microsoft. They also have other businesses. One of them is AV Ride, which does a lot of deliveries. They did over 215,000 deliveries in the United States, and they got an investment from Uber, which is amazing. They have another company called Triple 10, which is mainly online education. It 2x in revenue growth year on year, absolutely insane. And they have a stake in 2 more companies, and it's a very diversified company in general. Now, in terms of guidance, they're now guiding $7 to $9 billion in annual run rate by the end of 2026. And if you look at where the stock is trading at, this is around 3 times the $7 billion expected. 3 times revenue for such a company that's growing revenues 40% quarter on quarter and will likely grow revenues rapidly, maybe 50, 60, 70% a year for many years to come. This is extremely undervalued for Nebius. But I do have some problems with Nebius, and I want to talk about them, and I highlight them again. One of them is just looking at the income statement. Whenever I'm buying a growth stock or an unprofitable company, I want to see losses from operation improving every single quarter. I want to see an improvement versus the prior quarter. Now, in this case, I'm not seeing an improvement. It's actually getting worse. The loss from operation went from 80 million to 130 million. The company did increase revenues in a major way from 32 million to 146, but they're still losing more money than they did the prior year. And this is not a great trend in general. You normally want to see the loss from operations go down over time, but in this case, it's going up over time, which is something that I really don't like at all. And the company is not expected to be profitable anytime soon, not in 2025, not in 2026, not even in 2027. Now, the main counter argument is the reason why Nebius is not profitable is due to high depreciation expense, which is why we should use adjusted EBITDA for us to value Nebius. And that really works well with a lot of companies that depreciate real estate or a factory or something over the next 20, 25 years. Like, yes, they are depreciating the value, but the assets is still here and they can use it maybe for 50 years or 100 years or for pretty much forever. But this is not the case with a company like Nebius that has to buy new GPUs every 3 to 4 years and they depreciate a lot of value. And it's not the best thing to use. I don't believe in using EBITDA on Nebius. I believe we should be using net income. And the argument is, again, that Nebius only depreciate their hardware over a 4-year period which they believe is conservative compared to other companies. And this is true. CoreWeave depreciates them over a 6-year term. Nebius is doing it on a 4-year term. But I believe 4-year term is not conservative. I believe this is an accurate picture of the depreciation of those assets or those GPUs in general, as NVIDIA introduces new GPUs every 2 years. The previous generation will lose not just its value in general, but also the per hour that Nebius can charge for the workload on those GPUs. It's going to go down a lot. So it's not going to be as attractive. And every 2 years or 3 years or 4 years, Nebius is going to have to go out and buy the new NVIDIA chips again. Why? Because now they're popular and their competitors are doing it. So they have to do the same to remain competitive. And this is the NVIDIA launches of the GPUs. They launched the A100 in 2020. They launched the H100 in 2022, Blackwell in 2024. They're expected to launch Rubin in 2026. It says in practice, by the time a GPU reaches year 3 or 4, demand shifts to newer generations. Assets can lose economic value far faster than their accounting life. And I agree with that 100%. And this is my main argument against Nebius is yes, it's growing a lot. It's an amazing company, but it's not really the best business model to be in because every 3 years, 4 years, they still have those GPUs. Maybe they can use them for another year or two, but really they have to go out and buy new ones. So the CapEx is constant. It's a CapEx heavy business. And this is really not the best business model to be in. Now, this is a rough calculation of how long it could take for Nebius to break even on those GPUs that they're buying. And this is, I believe, again, conservative estimates. But this chart uses $2.20 per hour for the H100. Nebius is currently charging $2 an hour. So this one is a little bit more optimistic. So they're assuming $2.20 an hour and a run rate of 80% on utilization. I believe this is fair. It generates $1.76 per hour with 32 cents in available OPEX and $1.14 in depreciation. That leaves 30 cents of gross margin per available hour. So if you take the total, this is enough to recoup the GPU investment in just under 2.5 years, excluding staff and overhead. So we did talk about the GPU life. We did mention that every 2 years, NVIDIA is launching a new GPU. But yeah, it would take Nebius 2.5 years just to break even on the GPUs that they bought 2 years ago. So it takes them 2.5 years. Then those GPUs will lose even more value because NVIDIA introduced the new GPUs. They're likely not going to be able to charge $2 an hour for them. It would be less. Maybe they can use them for a year or two, but then they have to take all the money and buy new GPUs and then do it again and then break even after 2.5 years. And after 2.5 years, NVIDIA launched new GPUs. So Nebius has to go and buy them again and the old ones lose even more value. So this is what I'm trying to explain is yes, the company is amazing. It's growing a lot. They have a lot of different businesses. AV Ride is a good one. And the other one for 1010 is a good one. But in general, the business model is really not the best. And we're talking about this right now. Now, there's a lot of those companies like Nebius and CoreWeave that are popping up all over the place. Now, yes, we have massive demand, but maybe someday we're going to have way too much of the compute kind of supply that maybe is going to be more challenging in terms of Nebius to charge whatever they charge. And maybe that rate will eventually come down. And if it does come down, then it's going to take even longer than 2.5 years for them to just be break even on them, which is why NVIDIA has invested in Nebius, it has invested in CoreWeave, because the only beneficiary at the end of the day, the one that's selling the shovel, is NVIDIA. It's not Nebius. Nebius will benefit, but not as much as NVIDIA. And CoreWeave is doing the same thing, but CoreWeave is actually charging $4.25 an hour, and at 80% utilization, it would take them 1.3 year payback period with similar cost assumption. So this is a little bit better. And again, I don't own CoreWeave. I couldn't care less about it, but I'm trying to read this article to you as I believe those numbers are fair. And in this case, it would take 2.5 years to break even on those GPUs. But then Nebius can maybe use them, but they're not going to get as much as they did for them because NVIDIA has introduced the new GPUs. So Nebius has to go back and then maybe take the profits if they have any profits or raise money from convertibles to go and buy the new GPUs for them to remain competitive. And the only thing I don't like about it is, the business model, and I'm not sure how they're going to eventually turn it profitable. Now, Nebius is diversifying away from that, and they're getting into cloud and a few other things. And I think AV Ride will likely be a huge success for them. And they're doing really well with that. And I think the company has a bright future, but I'm just not a big fan of the business model in general. Now, having said that, the company is still growing 380% revenues. Next year is expected to grow 368%, 2027 up to 81%. I would not be surprised at all. The revenue growth is sustainable as long as they can find the money to put in the capex and the demand is there. That's why Microsoft has signed a deal. That's why Meta has signed a deal. So I'm not really seeing a demand problem in the short term, and I'm seeing a lot of growth. But my main concern is, again, the business model and how they can turn it into a profitable engine. But I personally believe Nebius is looking very attractive over here with the deal of Microsoft and with the deal of Meta. It's much more attractive than when I did my bearish video 2 months ago. So this is a company that could potentially be open to investing in, even though I talked bad about the stock. But the revenue growth is so massive that if they keep on growing it and they reach $8 or $10 billion in revenue, even more than 10 billion, now they're getting close to that, maybe 30 or 40 billion. I mean, if they get a tiny net income margin on that, if they somehow find a way to be a little bit profitable, the return on that's going to be insane. So I really like it as a speculative investment, you could say. I think this is a speculative investment in general. It would not be a core holding of mine. I would not put in, let's say, 10% of my portfolio or go all in the stock. I would buy a small position if I ever bought Nebius because it's really cheap at 3 times 2026 guidance for such revenue growth. And if I'm right, I make a lot of money. And if I'm wrong, I don't lose too much. So that's how I'm thinking about Nebius. I like it a little bit better than I did in my last video, but my main concern around the business model remains the same. And that was my opinion on Nebius. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.